recorded. So it would be great if all of you can have your video on, because this is more of a casual session rather than a regular school class where questions will be asked at you and all those kind of stuff. Okay. Here, whatever questions or queries being asked is more for an interactive purpose rather than questioning someone. Okay, and there are no rights or wrongs in such sessions. Okay, so it would be great if you can have at least students, if they can have the video on, and not specifically students. There are no differences between students and elders here. So it's all same. Okay, so we have also Krishnadas here, who is the mentor for the course which is starting tomorrow, which is a bit more of a longer course, a 12-hour session on accounting and finance. It's called the Art of Money Management. So that is what he takes. So that starts tomorrow, 3 sessions a week, Monday, Tuesday, Wednesday, like that 4 weeks. So is there. So I think, yeah, CNN is CP Narayanji. Yeah, now I realize. Okay. So then we have also TC teacher here. Welcome. And I can see Ritish, and I can see other regular faces like Rishikesh, and all, Manu, Atharv, and all. Okay, and Pujashri is new today. Sanjana is also a regular student. Shreyas, I don't know. Okay, so this course, the purpose is to introduce you some financial instruments, and the context is like Pradeepan used to take a couple of courses in GrainEd. One is on globalization, second is more on supply and demand kind of stuff. And that is the time we were noticing many people losing money on Ponzi schemes, fraudulent financial schemes. So we were discussing one day, and we thought, why don't we offer a course on how to choose financial instruments for saving, so that at least the students can go and tell their parents, there is a danger in this one, and don't go for this Ponzi scheme kind of stuff, right? So we see in cryptocurrencies and so many other stuffs, and people lose money regularly, even so-called educated people. I was just reading the other day, a vice chancellor of a university in India losing money on a fraudulent call. Don't want to name the person, but that happened, I think, 2 months back, right? So such things are quite often. So we thought, why don't we do a course on that? So that is the background for doing this course. And introducing Pradeepan, he's actually a computer science graduate. That is his official educational degree. And I think he works also in computing. But then his passion is in economics, like many of us. We all did engineering, but then later we realized that sociology, history, and economics is where I think the real game lies in. So we all started focusing more on such areas. So Pradeepan went and did an MBA in finance from the iconic Booth School of Business in Chicago. And he works there in Chicago in US. So this course we planned for 3 consecutive Sundays, today, next Sunday, and next Sunday. But there's a minor change. Next Sunday, Pradeepan has a small conflict in assignment. So the class will be like this Sunday, next Sunday no class, and next Sundays. So 3 Sundays remain same, but the coming Sunday there won't be a session. That is pushed to the further 2 Sundays. Okay. So with that intro, I would like to invite Pradeepan for this course, and to all those who are here. This pretty casual world of GrainEd where everyone is a student and everyone can tell and ask questions, and there is no rights and wrongs here. Together we learn. Okay, so be cool and be relaxed. Over to you. Okay, P.
All right, thank you, Sadish, for the introduction. So, so I have a PowerPoint, and I will, share my screen, and we will go over it. So let me do that first. Okay, so I think everybody can see my screen, correct? The PowerPoint presentation, or no?
Yes.
Okay, all right. Okay, 1 second, let me move this thing over here. Okay. All right, so let's start. Okay, so first thing I want to talk about is like this is going to be a very informal session, and these are some of the objectives. 1 second, let me make some arrangements here. I'm trying to do it on 2 different screens, and that doesn't seem to be working. So let me change it to 1 screen. Okay, all right, all good. So why are we doing this, right? So the first thing that we have to keep in mind is like, even though you may not be a finance professional or someone who is actively investing in anything, you may just be a student who is never interested in finance. You may end up becoming a doctor, you may end up becoming an IT professional or somebody else. But we all will have to make financial decisions one way or another in our lives. And most of the time, people without the basic knowledge of finance, they tend to make wrong decisions, and they tend to make mistakes. So the purpose of this course is to basically introduce you to the basics of what investments are, and give you some sort of a framework to make better decisions. It's not going to be like I'm not going to say like buy this stock or buy that stock, but at the end of the class, you can ask whatever questions, and it's completely open. You can ask whatever, and if it is something that I know, I will try to answer it. So again, let's go through the objectives. The thing is, like, every one of us make investments or take loans during our lifetime, and we want to make sure that we do the best thing. And this course is not meant for just financial people, but for everyone, because like I said, everyone has to make some financial decisions during our life. And why do we have to make financial decision? Because nowadays almost anybody will have to get a loan, almost anybody will have to get some sort of insurance, and life insurance or home insurance or whatever. And we all, assuming that we all have like enough money to invest in future, we have to make decent investments. And the cost of making a wrong decision here, it will have lots and lots of repercussions down the line. So with that, I want to start with this thing. Basically, let's say you have 1 lakh rupees with you, right? So, and then my question is like, what will you do? I want to hear some answers, but like Sadish said, there isn't really no right answer or wrong answer or anything like that. Nobody is going to evaluate you based on that. Hey, you said right or wrong. I just want to hear the feedback and the thought process behind it. Like, why would you do this? So these are the choices. Sadish, is it possible to create a quick poll? I should have probably warned you before.
Yeah, this with whatever you have written here.
Yeah.
Yeah. So if you can cut and paste this to me in WhatsApp or in chat, it will be easier for me.
Yeah, sure. Yeah, I'll just copy this and paste. While Sadish is doing, probably everyone can get a little bit of time to think about it. Where is the chat here? Okay, chat is here. Okay. If anyone want to answer that question now, it is fine. Whatever you can think of, what is the best way to do
Can
this?
I answer?
Yeah.
Sir, so I would most probably invest in cryptocurrency like Bitcoin,
Okay.
or because
And
right now, if I invest in cryptocurrency, I'm sure that later on the value for what I invested right now will increase. So I'll get more profit than what I've invested right now.
Okay, so what you are essentially saying is whatever money you have now, Bitcoin or crypto, I just put Bitcoin, but it can be any cryptocurrency. So any cryptocurrency will give you the best return in the long term, right? That is why you're investing in that, correct? That is the
Yes,
idea.
sir. Yes, sir.
Okay. Who was that?
Sir, it was Ritesh.
Okay, all right. Okay, what about someone else? So we already have one person who is going to invest in crypto. Anybody else want to say why, where they are going to put the money and why? Biju or a Tessie teacher?
Mutual fund.
Mutual fund, okay. And why, what is the reason behind it? Again, there is no right reason or wrong reason.
Because I attended your class once.
Oh, okay.
So
Okay.
Before I was thinking buying gold. After attending your class, I thought to change it to mutual fund.
Okay, but why mutual fund, right? I mean, what is better for mutual fund compared to gold?
I don't know how to explain it properly, but
Yeah.
in long term, when we consider, I feel that is better than gold. Gold value we can't say.
Okay, so again, basically you are looking at a longer term perspective and you think mutual funds will do better than gold in the long run, right? I mean, that is a fair way of, okay. All right, so we can see the results here. Okay, I think half the people answered. I think everybody can see the answers, right?
No, unless we publish it.
Okay.
So
publishing is something you can do, Sadish, right?
Yeah, so to close the poll, so last 10 seconds, after that you'll close the poll. Last 10 seconds.
It says 10 out of 13 answered.
So closing the poll in 5 seconds. I hope all can see the poll results now.
Yeah, can everybody see the poll results?
Yes.
Yeah, so I see like a lot of people, 36% is buying gold and buying Bitcoin, and then and buying stocks. So that those are the preferred choices. And then there are like 18% of people put it in bank or bonds, and none of the above. And nobody is going to give a loan to someone and charge interest, and that is interesting. Okay. So we will stop sharing and then we will go over the next slides. Okay, stop sharing. Okay. Okay, so but before we go there, and we will come back to this. So before we go there. What is an investment, right? The purpose of an investment is basically you have some money, and when you have money, you can do two things with the money. Like you can either spend it today or you can invest it for the future. And why do you want to spend money now? Because you know you want to enjoy all the good things in life, because you have to do it now. And why do you want to invest money for the future? Because in the future you may not have any earnings, and in those cases, when you don't have any earnings, you want to have some savings from which you can spend. Say, for example, if you want to have if you want to buy a house, right? You don't have the money to buy the house immediately, so you save little by little by little. That is one way of buying a house. The other way of buying a house is like you take a loan and then pay off little by little by little. But in any case, an investment is something where you set aside money for future with the hope that you will have the best returns. So when you invest money, right, this is coming in the next slide. So a lot of people said, okay, they want to buy gold, you know, they want to buy Bitcoin or you know, some other stocks or something like that. So my question is like, and this is anybody can answer it, you know, maybe I think it is better to answer, or if they prefer, they can do a chat also. Like what I want to know is like, other than return, almost everybody think that, okay, except a C teacher, right? Maybe the C teacher also said that. So almost everyone here, I think they mentioned that they are going to invest money because, you know, they think stocks or mutual funds or cryptocurrency will give you the best return. So definitely return is one aspect of investment where, you know, you want to get the best return. What other aspect you will consider other than return? Or is return meaning like, you know, you put you know, 1 lakh today and you will get 2 lakh tomorrow? Is that the only thing that you consider when you choose an investment?
Security, safety.
Correct. Security and safety. Yes. So sometimes, and this is what I think Satish was saying, some PVC vice chancellor or somebody put money, and I think, I don't know what his mindset was, but I think he was expecting a very good return, but he lost all the money. And this is something, and in finance, these things are called return and risk, and we will go to those later. But whenever you make any investment thing, you have to remember about two things: return and risk. And most of the time, people only think about return, and because everybody is like, I want to have I have this much money, I want to make more money, I want to make more money. But almost always people forget about the risk. And if you forget everything that I say today and in the next class, but if you come out with one single statement, one single theory, one single idea from this class, it should be this: that when you invest something, anything, you have to consider both the return and the risk. And that is the whole purpose of this class. So even if you forget everything else, it is fine, but don't forget this. So, okay, with that, let us go to the next slide. And then I will explain what is, what is risk and what is return. So what is return? Return is like, okay, you put some money, you expect to get more money. So that whatever extra money that you get, that is what you think as return. So you invest, you put some money in gold today, you buy it for whatever price, the price go up, and then that difference between what you bought and what it is worth at some future point in time, that is your return. And risk is actually, it's very difficult for people to understand the risk. And that is why a lot of people just look at it from the perspective of return. Risk is something like, basically in life, if you want to take it from at a higher level, risk is something like, it goes like this. You expect something to happen, but something else happens. That is a risk. So in investment, what is that something else? Can anybody say? Pick an investment that you chose, like Bitcoin, say for example. I think there were some people who talked about Bitcoin, and their return part is like they will make a lot of money. But what is the risk of investing in cryptocurrency or Bitcoin? Have you thought about it? First of all, have you thought about it?
Value can be decreased.
Sorry, I can't hear. Can you speak a little louder?
Value can be decreased.
Okay, value can decrease. Okay, that is the risk. Okay, anything else? Anybody else want to say about their preferred investment? You know, like gold or stock or anything, and then think about what is the risk aspect of it. So what if you buy stock? What is the risk?
Value may decrease.
Value may decrease. So I think in some cases it could be like really extreme. So cryptocurrency, it may just not be the value will decrease. It may go even to zero. And I'm not saying it will go to zero, but there are investments where, you know, people put money, a lot of money, and instead of just a little bit of reduction in the money, they lose everything. And that is what we call a risk. So anytime you look at an investment, you have the money, you have to make a decision. You have to basically consider what is the risk and what is the return. And then based on that, you choose whatever is appropriate for you. So what we are going to do next is basically go through a list of all the investments that we have discussed, you know, like bond, you know, gold, stocks, and all those things. And then we will try to find what are the risks and what are the returns. So before that, anybody has any questions or comments or anything like that? Nothing? Okay.
So,
All right.
KP, you are not putting this in slideshow purposefully, right?
Yeah, you know what? I will put it in a slideshow. This is a little annoying, right? Okay. What is so important? Okay. All right. So let us say I will try to illustrate a risk with this. Okay. Let us say we all know about Vasco da Gama, right? And we know that Vasco da Gama came to Kerala. Why did somebody like Vasco da Gama came from Portugal to Kerala? What was his purpose?
Trade, a trade route.
Trade.
For...
Yeah. And why do they want to do trade? I mean, we are going one more level down. Okay, trade is a good answer to start with, but why trade?
Because we can earn, you know, like if
right. So basically, exactly. Yeah. I mean, you know, they are trying to trade something that they can buy something from, you know, a place like Kerala or India or someplace and then bring it back to their country, Portugal. And this was happening with, you know, Portugal, Spain, or wherever it is. And then maybe sell something that they have to people in India, and in that process make money. So, okay, so think of it as an investment, right? You are, Vasco da Gama come to you, and then he is saying like, hey, come with me, you know, you do this trade, you come with me, you go all the way to India or wherever, you will make some money. Will you do it or no? You have an option to make money. Think of it as your return that you get from an investment. Because back then, you know, there were no mutual funds or Bitcoins or something. So think of it as like you are living in that time and you want to make money. Somebody come and say, hey, this is how you make money. So how many of us will be ready to go with Vasco da Gama on this voyage to make money? Again, there is no right or wrong answer. You know, pretend that you are living in that time and you have this choice. What will you do?
So if it were me, I would first like get to know the risks of going in a voyage to trade.
Okay, so you will look at the risk. Okay, you know about the return. Return is like, okay, you will become rich, but you will evaluate the risk. Okay, anybody else? There are a lot of people here. I just want to hear something again. There is no right or wrong answer. We are just trying to understand some concepts here. Okay, so what is the, first let us look at the return. What is the return? The return is like, you will become rich, and that is what you expect, right? And that is the other concept with the return. The return is most of the time it is what you expect it to be. It may not happen. So let us see what happens with the actual thing. Okay, so you have this option, and will you accept it? Okay, so anybody, I just want to hear someone say whether they will accept or not. Just a gut feeling. I'm not going to ask you why. Just say yes or no.
Hey, okay, this is Santosh here. I will accept
Yeah.
it. It could very well become the trip of your life.
Okay. Yeah, that is a good way to look at it. There are a lot of people who look at something like, I'm willing to take a risk because it is going to fundamentally change my life in a better way. Okay. Anybody else? Okay. So let us see what is. So return is like, like Santosh said, you may become rich and powerful. And it's not just like a little bit rich. It is like, once you make this voyage, you come back, you'll be like super rich in that society. Okay, what is the risk? And here is the interesting thing. And it won't happen with, stock investment or mutual fund investments today, but back then the risk is like really high. You may die actually. And there are a lot of people who were not willing to take this risk and they were worried. And for that reason, what happened was like when they recruited the sailors, many of them were convicts because these convicts were anyway, they are in jail. So they don't really have a lot of good things happening in jail. So they are like, yeah, I'm going to take this challenge because if I become successful, I will be out of jail and I will come back and become rich. If I am not successful, I may probably die. But anyway, I'm in the jail anyway. It's not a pleasant life here. So what happened actually? Many of them actually died because of scurvy. Scurvy is some sort of disease. And this used to be very common back then. People who used to do all this kind of trade, where they go from one country to other in, seas, they cross the seas in their ships and things like that. And these are like not very powerful ships like modern day ships, right? So there is a real risk of you dying from the voyage. And back then, people who do this kind of trade, whether it is for East India Company or some other companies before that, people used to die. But if they don't die, they will come back rich and powerful. Now, I don't want to scare you or anything, but when you look at investments, again, you are not going to die, but this should be the way you look at it. Like, okay, if I'm successful, I will have more money, but if I fail, I may lose something. And what is that something I'm going to lose? And am I willing to lose that something? Can I tolerate that something? And that is how you look at this investment decision. Okay, so now let us go through a lot of investment choices that we have, right? We will start with the bank deposit, right? Everyone know what a bank deposit is, right? Basically, in India, you have like a regular deposit. I think, what is it called, Sadish? Other than the FD, what is it called in India?
It is
Just a
a
savings.
regular savings account.
Savings.
Okay. Okay, so you have a savings account and you have what they call fixed deposit or FD. So when you deposit money in a bank, what is your return when you deposit money in a bank? Anybody? These are like very simple things, What do you get or what is your return when you put money in a bank?
Interest.
you get some interest, right? And again, like, we discussed, there are two type of interest, two type of bank deposit. One is a fixed deposit and other one is savings. Which one will give you a higher interest rate?
Fixed.
Fixed. And why is that?
Yeah, typically keeping it with the bank for a longer duration.
Right. So this is other thing you have to, exactly, Santosh. This is other thing we have to look at it, right? Whenever you get a higher return from any investment, there is an underlying reason for that. So when someone come and say like, yeah, put money here, I will give you very, very high return, you have to ask him like, why are you able to, or how are you able to do this? And why is that return high? Usually when you have a higher return, that means like couple of things, like one is like it is a riskier investment, and the other thing could be like you have certain inconveniences associated with it. Like if you put money in fixed deposit and something happens, you want the money back immediately, you want it urgently, you cannot take it out. So basically you are suffering a lot of inconvenience, and somebody is getting money from the bank in this case continuously for 3 years. So whenever you have inconvenience, whenever you have these kind of choices to make, if you have some inconvenience, you should usually get a higher return. So that is a return part. A return part is like return part is actually interest, and at the end of it, you get your principal back. Now let us think about the risk. Do you think bank deposits are risky? How risky is a bank deposit? Or in other ways, what is the probability that you will lose money in a bank deposit? Anybody?
Sir, I'm not sure, but then if we don't like keep it in a fixed deposit or something, and we don't like deposit some money every month, I guess the bank will keep withdrawing it to themselves. The bank will like reduce the amount in our account.
Okay, so that is one point, because basically what you are saying is like, okay, bank will take some money out of your account if you don't have any transactions or if you have a lower balance, right?
Yes, sir. Yes.
Okay, so forget about that. That is actually true, but I think for the purpose of our discussion, so what other bad thing can happen to your money when you put it in a bank? Can you think of anything bad happening to your money? Usually the answer is no. I mean, almost always the answer is no. But again, it's not like it's not like so usually you get the money back, right? So because in India and in USA, in many other countries, bank deposits are insured. That means even if the bank goes down, even if there is a problem, you will get the money back. But then again, you have to be careful here. If you put lot of money in the bank and the bank has some problem, your deposits are insured only up to some point. So generally speaking, you can say bank deposits are safe in the sense that there is a bank behind it, there is a regulatory authority behind it, there is a government behind it. So very rarely you lose money in a bank. Again, it also depends on the type of bank. Some banks are safer than other banks, depending on whether they have a lot of assets, whether they have a lot of regulation going behind them, whether so there are all kind of banks, private banks, public sector banks. But generally, you can say bank deposit is very safe, because if you put some money in a national bank or in a safe bank, you will almost always get the money back after 2 years or 5 years or whatever with some interest. So in the spectrum of investments, we can say that bank deposit is a safe investment. But what do you think the return that you get from a bank deposit? Do you think it is high or low compared to other investments?
Low.
Low, okay, correct. Okay. So do you see a pattern here? And this is the other thing I want you to take from the class. Usually when you look for safety, you want safer and safer investments. Usually you will get lower and lower returns. And conversely, if you are looking for investments with very high return, it will be riskier and riskier, because otherwise everybody will, if a risky return is like really safe, everybody will take that return. Everybody will take that investment. So generally speaking, this is another rule in investment, which is like when you aim for higher and higher and higher returns, you are actually taking higher and higher and higher risk. And what is risk? Risk is something that whatever you think of happening will not happen. So in the case of a bank deposit, you think that, okay, what is your expectation after 5 years or 10 years or 2 years, whatever your term is, you will get the principal back, you will get the interest back, and that is very likely to happen. Very almost, you can say close to 100%. So because it is guaranteed to happen, you will get a lower return. Okay. Someone mentioned about investing in bonds. I don't know who it is. Can anybody tell what is a bond? Okay, you can think of bond as a loan, but instead of you giving loan to somebody, instead of it goes like this: somebody wants the money, right? And then you are giving a loan to that person, and it is different from a private loan. So for example, I want some money and I ask Sadesh for money, and Sadesh is like, okay, here, I will give you some money and I will charge you interest. That is more like a personal loan. But in the case of bond, what is happening is it is usually the government, they need the money, or like some huge corporation. So, but even though it is called bond, it is basically a loan. You are giving your money to the government, like the Indian government. If it is an Indian government bond, you give money to Indian government, and then they will give you again, nowadays it may not happen, but I mean, they will give you earlier they used to give you a piece of paper saying that, hey, me, the Indian government, owe you this much rupees. Or this is a picture of some old United States treasury bond. So in this case, what happens is like you give this as a face value, what they call a face value of $1,000. So basically you give $1,000 to United States government, and then they will give you at least, figuratively, this piece of paper saying that they owe you $1,000. And then what do you get in return? So every 6 months, you get an interest. Whatever interest rate set in the bond, you will get an interest. And after maturity, you get the whole $1,000 back. So think of it as a loan that you give it to a government or a company. And then at the end of the maturity, they give the money back to you. And during that time, they will give you the interest. Now, why would you, okay, now think about it. Now you have some money. We are going to compare bank deposit and bonds, right? You have some money and you have the option to put it in a bank or in a bond, right? So where will you put the money now? Again, no right or wrong answers, right? I just want to know the thinking process behind it. You can put the money in a bank, or you can give it to the government. So let us say in the case of US, it is a 10-year bond, which means you get the money only after 10 years?
I think putting money in bank will be safer. Depositing.
Okay, so you think it will be safer and you will put the money in the bank. Okay, anybody else?
If you're
So
seeing
I'm
the
like
chat
quite
also.
Oh, okay, so let me see that chat 1 second.
Sorry, Ritesh.
Generally bank. Okay, okay, that is okay.
Sir, I have a doubt.
Yeah.
Sir, in this bond, for example, a government is taking, then they will take 10 years or so, like a long time to return the money back.
So I will come to that later, but there are many different kind of bonds. You know, there is at least in US there is a 2-year old bond. I think they are called. They are not exactly called. They are bonds, but they have a slightly different name. But anyway, so there is a 2-year-old, there is a 10-year-old, there is a 30-year-old. So,
Okay,
so for the purpose of my question, think that it is a 10-year-old bond. Okay, I think there is really no easy answer here because bonds are issued by many different entities, right? So generally speaking, all over the world, people consider a bond issued by US government to be very safe. And because of that reason, you will get a lower rate. It is actually supposed to be slightly more safer than a bank. Again, it depends on which country's bank that you are talking, and there are a lot of other issues. And same thing with the Indian government. I think you can say that a government bond is slightly safer than a bank, and the reason is like governments can always print money and pay you back, whereas a bank, if there is a problem, they don't have the money, they cannot pay you back. So it is almost the same, but I would say bonds issued by some entities, and we will come to that in the next slide, are safer than bank deposit, but bonds issued by some other entities are less safe than bank deposit. Okay, so these are some of the things that you have to look when you invest in bonds, right? And this is the other thing that I want to go through. Like, so when we start with bank deposit, the picture is like very simple, right? You go to the national bank or a good bank and you put money there. They are all very much the same, whether you go to State Bank of India or some other bank. I mean, they are all probably safe in this. They all have the same safety. They all probably pay you similar interest rates. But when you come to bond, the picture is more complicated, right? So there are bonds issued by different countries. There are bonds issued by different companies. There are bonds issued for different time periods. So a 2-year bond, and this is, I think this is what Ritesh was asking, right? 2-year versus 30-year. So there are some bonds pay you in a dollar or some other currency. Some bonds pay you in rupee. So it becomes a little bit more complicated to figure out like which bond you want to put your money in. And the next slide has some examples. Okay, so let's look at different kind of bonds, right? The first one is, and this slide, this screenshot was taken a while ago for my last class. So some of the numbers may be different here because the interest rates change daily. But this will give you some idea. Okay, so let us look at US government bond, right? Which I told one of the safest investments in the world. So 1-year bond only pay you like 0.06%. It is not even, it is almost close to zero, right? Now, my question is like, why would someone want to invest in a 1-year US government bond which pays interest very close to zero? I mean, it is almost as if like you get no money back, right? But still, there are lots and lots of investors all around the world who put money in US government bond. Why?
So because the risk is pretty much zero, and then you are definitely sure that your money will return.
Okay, that is one good answer. Okay, very good answer. But let us say that let us follow the same path down, right? So if you look at US government, you see that 1 year is giving you 0.06%, but 30 year is giving you 2%, right? Why is that? It is the same US government, it is the same dollar amount. Why is a 30 year giving you 2%, whereas a 1 year is only giving you 0.06%? Anybody? So this is other pattern you see if you look at this picture. Every time you see these are called the duration, the thing called 1 year, 5 year. So anytime you see the duration going up, you see the yield or interest, yield and interest rate are slightly different, but let's think of it as same, going up. And the reason for that is, think about it, right? You have, like in the case of US government, you have $1,000. You give the money, you get it back after 1 year. So you have the money with you for the remaining 29 years. You can do whatever you want with it. Whereas if you buy a 30-year one, you are stuck with US government for 30 years. You don't have the money that you can use after 1 year. So people like that convenience, because what if 1 year from now you need the money back? Maybe 1 year from now there is a better opportunity, or maybe 1 year from now US government is going bad and they are not as safe as before. So a lot of things can go wrong in 30-year-old period, right? So because of that, generally when somebody asks you money for a long period of time, you would just say like, yeah, I will give you money, you are safe and everything, but I'm going to charge you a higher interest rate, because there is a long period of time where you don't have your own money with you. Is that clear?
Sir, I have a doubt.
Yeah.
Sir, like now I sign up a 30-year bond, but now will the US government give me back my money like after early, before 30 years, or only exactly?
No, they will not, right? That is the idea, right? If you directly, there are bond mutual funds and all those things, but if you directly invest in a bond, a 30-year bond is basically you will get the money after 30 years.
Okay, sir.
Yeah, but what usually happens is like, all these investors, because there are many people who buy and sell these bonds, you can actually sell your bond to somebody else. So 2 years from now, you can sell it to Satish, and Satish is like, okay, now this I have to give money to somebody for 28 years. So he may say like, okay, I will charge a higher interest rate, but not as high as 30. Or after 20 years you sell it to somebody, then it becomes, in effect, it becomes a 10-year-old bond. So the interest rate will be lower. You can always sell these things in a secondary market. You don't have to wait. But when you sell it, I mean, the buyer also is looking at the same idea. Like he may be looking at it as like, okay, this is US government, this is dollar. It has now 20 years left if you sell it after 10 years. Now let us come back to Indian government, right? Again, Indian government, the rates are higher. So for 1 year, the interest rate is 4%. Why is that? Why do Indian government have to pay 4% where US government is only paying 0.06%?
Sir, I guess it's because of the currency difference.
Okay,
The value of the currency, like US dollars, is more worth.
Yeah, but more worth, but wouldn't that be the same, like 1 year from now? Yeah, I think I mean, your answer is correct. I think what
also see the chat. Okay.
Oh, okay, let me see the chat. It is because of bank rate of central banks. Yes, yeah, okay, correct. So I think what happens here is like if you are a global investor, right, you can invest money anywhere in the world. So they may think that, okay, 1 year from now, Indian rupee, like you said, Indian rupee may go down. So if it goes down like, 2% or 3% or something like that, then, so let us say hypothetically, Indian rupee go down by 5%, right? Just some number. I'm not saying it will, just some number. So in that case, you are better off putting your money in a dollar, even though it won't give you anything. Because even if you get 4.18% from Indian rupee, if it goes down relative to dollar, you are actually losing a little bit of money because you could have made more money by putting it in dollar. And that is what the central bank thing also means, because the central banks have different interest rates, and whatever the interest rate the government set, everything else revolves around that rate. So the other risk is like there is a slightly higher risk, from an investor perspective, that an Indian government may default. This is when they say default, it means that they may not be able to pay the money back. Usually for very small amount of time, like 1 year and all, they don't care. But nobody really knows that 30 years from now what is going to happen to Indian rupee or Indian government's payment. Nobody knows that what is going to happen to US government payment also, but they think generally that the risk is higher for Indian government for two things. One is for the rupee going down, and two is like for some reason the Indian government will be unable to pay. And now let us look at Microsoft. This is a private company. They have dollar, they pay in dollar. Microsoft 2-year is 0.15%. Microsoft 20-year is 2.44%. So if you compare these things, Microsoft is paying you a little bit higher than US government because, Microsoft as a company 20 years from now, nobody knows what is going to happen to them. So it is less risky. And think about our KIFBI loan, right? So KIFBI loan, and again, this data is a little old. They, for their 5-year thing, they are paying 9.72%. So compare that with Indian government 5-year paying only 5.5%, because like we learned from the class that people think that KIFBI loans are riskier than Indian government loans. That is why they have to pay a higher interest rate. So again, if you look at the big picture here, when someone thinks that an investment is riskier, say for example, in the US government versus Microsoft, or US government versus Indian government, something like that, whenever someone thinks that something is riskier, they will immediately say, I will need more interest. I have to have a higher return. Otherwise, I'm not going to put money in a riskier investment. Okay, I think we will talk about gold and then we will stop for today. So gold is very special for a lot of Indian people, like compared to the rest of the population in the world, right? Why do people buy gold? Can anyone think of a reason? Because it is not going to give you an interest, right? I mean, the gold that you buy, it's not going to produce an interest. It's not going to give you a dividend. But why do people buy gold?
So like cryptocurrency also, if we invest in gold, then later on the value of the gold will increase.
Okay, so that is the reason. Basically, you are saying like, I'm not getting any immediate return, or I'm not getting any yearly return, but in the long run, you expect the price of gold to go up. And for a lot of Indians, another reason is like, at least not now, at least like a generation ago or something, there weren't that many bank deposits. It was not very easy to open up a bank account. Most people don't have the banking experience. It was difficult to buy stocks, mutual funds. So for a long time, for generations of Indians, the only way of investment was either buy gold or buy land, or land or house or something like that. So many of them didn't have the opportunity to get into other financial investments. So instead of just putting money as cash, they would buy gold because the expectation is like gold will go up in price in the long run. And this is one interesting thing. Indian households collectively, meaning all Indian households put together, they are one of the largest investors of gold in the world. So Indians buy lots and lots of gold. And I think once we have more and more opportunities to invest, like in stocks, mutual funds, and other things, it may be possible that the attraction of gold will go down a little bit, but still gold will continue to be an investment. Okay, so I think it's almost 10 o'clock. So we will start with stocks and mutual funds and other things. Actually not next week, the week after next. So we will go through. Let me give you an outline of. So we have seen everything from bank deposit, bond, to gold. Now we will go through stocks, then Bitcoin, little bit of Bitcoin, and then mutual funds. Yep, and then returns and risk of each of them. So any questions at this point?
Hi, PT. This is CNN. I just want to make a small observation. Of course, it's a high economics when we talked about the interest rates, the differential between US and India, and you mentioned about it. But just a slightly different observation that the interest rate differential is primarily driven by the inflation and not to do with the riskiness of the Indian government bond vis-a-vis the US government bond, because both are sovereign bonds. So all those bonds which are sovereign are always AAA rated. So to that extent, there is a parity, but the interest rate, maybe for the students to understand, the interest rate differential is primarily driven by the inflation and the purchasing power parity of the currency on which that loan is denominated. It's a high economics. I don't know whether the children of this.
Yeah. That is correct, right? That is one of the risks, right? So yeah, in the case of U.S. government, yeah, you're absolutely right. In the case of U.S. government bond versus Indian government bond, the primary reason is the difference in the inflation, expected inflation rate. But I think there is still a little bit of I don't want to say default component. There is a little bit of a risk component, because when Indian government issue a bond denominated in US dollar, because basically now you are comparing apples to apples, right? There is a US government bond and that pays dollar. There is an Indian government bond that pays dollar. So there is no foreign currency risk. There is no inflation risk. Even in that case, the bonds issued by Indian government that pays in US dollar, that will be slightly higher than the interest rate or the yield will be slightly higher than the one that issued by US government. But yeah, you're right. I mean, there are two components.
Yeah, no, absolutely correct. There will be always a risk premium attached to the US denominated bonds. Definitely, there could be a marginal increase in the interest rate if it's a dollar-denominated loan raised by the India government in US market. Definitely, it will not be 0.06. It may be 0.08 or something. That's true.
Yep. Very good point. Yeah. yeah, some of the concepts are like, I don't want to take it too advanced, right? I mean,
Understand. The children are too
yeah.
small to understand this dynamics of economics. It's an excellent presentation. I think it's very, very good to make children realize the very fundamentals and the very nuances of basic investing techniques. And I'm sure that I look forward to your classes in the future. You will be teaching them much more advanced aspects of investments. Thanks.
All right. Okay. Okay. Thank you for the compliment. Any other, I mean, you can, I mean, if people have time, I have time. If there are some open questions or something related to this, we can discuss that.
So I have a doubt. So why
Yeah.
would like a big, big organization, like for example, the US government take a bond?
So your question is like, why do they need to issue
Yeah,
bonds?
because their economy is also really high, right? Then why do they need a bond?
Okay, so the way it works, and I think almost all countries issue some sort of bonds, is because this thing called budget, right? So in a budget, almost I don't know every country, but a lot of countries have what they call a deficit budget. I mean, India has a deficit budget, USA has a deficit budget, most countries. So what that means is like basically the government spend money and their source of revenue is the taxes that they collect from people. So almost always they spend more than they collect. And I think we can go, the reasons for that is a little bit complicated. It is something to do with the thinking that, you have an obligation to people, or you think that sometimes deficit spending will increase growth, or sometimes it is just that, things like COVID, they have to put money back into the economy and they don't have the money. So they have to get money. So that is a reason for getting money. So in a nutshell, it is like government has to spend X dollar. They only get Y dollar as tax from people. So that X minus Y, they have to get it from loans. That is why they issue bonds. And US government, even though it's one of the biggest economies in the world, their debt is like huge. I think it is almost same as their, pretty close to, maybe even a little bit higher than their GDP, something like $24 trillion. That is their debt.
Okay, sir, but aren't they like getting tax from their citizens?
Yeah, they are getting tax, but then that is not enough. So if you look at any budget, right? I mean, when you have some time, you can go online and look for Indian government budget or US government budget, and then look for like the revenues. And maybe Viju can explain it much better. I mean, he knows a lot about budgeting. So, but at a high level, you look for the revenues for Indian governments and the expenses. And almost every year, you will find that the expenses are higher than revenues. So what is the other solution? The other solution is, like tax people more and more so that the budget balances. But most of the time, the budget is in a deficit situation and then they need to raise money.
Okay, I got it.
Viju, you want to add something to that budget part?
Okay. So I think we should look at government, understand the size of the budget. So like national government, India, the budget is around 24 lakh crores. And a state like Kerala has got a budget of size of around 1.6 lakh crores of Indian rupees. So you can try and think of the number of zeros which they have. So if you take all the states and the center together, possibly our budgets on, something like around 50 lakh crores rupees. I'm just giving an approximate figure because some states have got higher budgets, some states have got much smaller budgets or unit territories. So this amount is very, very big. I mean, I don't think we have, it is 50 lakh crores. That it is not 50 lakhs or 50 crores. It is 50 lakhs of crores. So collectively, we don't have the buying power to feed this with taxes alone. And I believe, so if you take US or any other government, the expenses would be much more higher because their living standards are much more higher. So, generally governments are always running on deficit budget. I think only Germany was running on some sort of surplus budget. Very few countries, and I think that has helped Germany during this COVID pandemic period also, because they could manage their healthcare and all of that because they had surplus. But currently they might have again slipped to the deficit because of the pandemic. So yes, as was mentioned, that is one reason why governments need more funds. So they get the bonds like that.
Okay.
So
Yeah.
sorry, I was engaged in other activities, so could not participate in the initial part much.
No problem. Yeah, so I think, yeah, that was a good answer, right? I mean, basically, it's the same thing, right? Governments need more money than their revenues. Any other questions?
Okay, so I got it. Thank you.
So we wind up for the day.
Yeah, if there are no other questions or even comments, it doesn't have to be a question, like.
Yeah. Okay.
Any other
So the
comments?
next Sunday we don't have the session. That was the published schedule, October 3rd. But October 3rd we do not have this course. Our next session of this course is October 10th, and then the further one is on October 17th. Okay. See you all on October 10th, Sunday, same time, same link. Bye.
Thanks, sir. Bye, sir.
Thank you, sir.
Okay, thank you.
Okay. Bye.
Bye-bye.
Okay.
Bye.